In this video, we are going to learn how to analyze a backtest trading journal and how to understand if the data in your backtest tells you whether you should go live or if the strategy is not worth taking live. So this is a journal that was sent in by one of our users, and she asked us to take a look at her backtest trades, which we are now going to do, and we're going to walk you through a step-by-step process that will help you analyze your backtesting data to make then a final conclusion if you should go live or not. So the first thing that you should always ask yourself is, obviously, does the strategy make money overall? And we can clearly see when we change to the return, here is a very healthy looking around 65% net return. So at the first glance, this looks great. And however, one thing to always consider is you need to give those return numbers from a backtest a little bit of a buffer, because once you take this live, it's very hard to replicate the results of a backtest one-to-one. And typically you will see a small, sometimes a larger drop in your overall performance once you go from backtesting to live or even demo trading, because a lot of the factors that are difficult in trading or in real-time trading are excluded and not present when you do your backtest, of course. So we have to keep that in mind a little bit. The next thing we can do here when we look at the profitability is just take a look at how many trades did this take to realize such a performance and what is the span here of the trading data. So we have 141 trades. And what I find interesting, because this is a swing trading journal and there are differences for a swing trader and a day trader, of course. So for a swing trader, we can take a look at the calendar, and what we see, what is interesting is there are only a handful of trades every year that the trader has generated and was able to find. So there are years where there are only a few trades, and there are months without a trade, which is something that we definitely need to keep in mind. So when we look at this now, there are probably like 10 years of backtesting data that led to this 65% return. So you could say this gives you maybe a 5% per year return, which then might not look as tempting because you might be able to get this return by just passively investing your money. However, we're also going to analyze the scalability of such an approach. So are there ways to scale this up and get an even higher return than those 65% that we have here? When we look at the profitability, we can also then take a look at the win rate and how the returns are calculated and how robust this system is. So we have a win rate of 42%, which looks all right. But it looks even better when we take a look at this average P&L. Currently, we have the winners 2.4 times the size of the average losing trade. So that's a very, very healthy reward to risk ratio. And you can see the profit factor of 2, which is great. A profit factor of 2 is an outstanding number here. And you can also see the Edgewonk score here gives you a very high rating. And the actual Edgewonk score is a cumulative score based on a lot of different factors. And it shows very robust trading results. So this looks good. The win rate for a 2-to-1 or 2.4-to-1 reward to risk ratio system is also decent. This gives you a pretty robust trading performance here for this journal. So that's looking good. Another thing that we need to understand when we take a look at the return are transaction fees. Was this even figured in your backtest? And when we go here to the journal, you can see the fees are not calculated here. So this trader probably excluded the fees. And this can be a little bit of an issue because your performance is then not going to be 65% over those 10 years. It's going to be probably significantly lower. So that's something to definitely always keep in mind. However, as I said, we're going to look at the scalability and the possibilities to improve here the returns, maybe get more trades and see how we could do that later on. So something to keep in mind, but on the surface, it all looks quite interesting. And we would be very interested to hear in the comments below how you analyze your backtest. Would you take this trading strategy live? Let us know in the comments. So the next thing, trade frequency is something that you definitely need to take a look at. This is something that we see for day traders as well. When we look at day trading journals, very often we see that day traders, when they don't get regular trades, so if you are sitting in front of your charts every day to monitor the market open, but you only get a trade once or twice a week, a lot of traders will then be tempted to take random trades. In the backtest, this is not such a big effect because you can just fast forward. But in real-time trading, when you then have to wait a few days without a trade, a lot of traders will then take suboptimal trades. So the trade frequency is something really important to understand if this strategy gives you enough trades, because that could also then drag down your performance if you don't have enough trades. But of course, there might be ways to scale this up as we're going to explore. Another thing to always analyze is the holding time. For day traders, typically you want to look at trades that happen within a day. So you open and close the trade within the same day. Here, what we have is a swing trading journal, and you can see the holding time here stretches for many, many days here. One of the trades goes on for 125 trades. So transaction fees and fees in general will be a huge issue for this trader. So this is something that might not be optimal if your performance is not extremely stellar when you have trades holding for that long and then you have to pay those costs regularly. So the trade frequency you need to, the trade holding time you need to look at. If you're a day trader, something to always check is your performance by time. So when do you get most of your trades? What happens often in the backtest is that when you fast forward, you see a signal, you take that trade on your backtest, you journal it. However, then when you evaluate your strategy, you have to understand when do those trades happen? Do they happen when I have the option, or am I even able to take the trade? If, for example, a lot of your signals happen at night or when you're at work and you cannot execute a trade, obviously your performance will look vastly different in your real-time trading once you take the backtest strategy live. So looking at when those signals happen and if you are able to take them is really, really important to understand the true performance and what to expect from your trading system. Another thing to analyze is the drawdown. What is your return to drawdown ratio? What is your largest drawdown, so that you know roughly what to expect. When we switch here to percent, you can see the biggest drawdown is here only 6.28%, which is great. It's not a very big drawdown, and this shows that it's a very healthy system. You don't have long periods of losses, and typically you can see when the drawdowns happen, the trader gets out of them very quickly, which is also due to the very healthy reward to risk ratio that we have seen. So a trading system where you see very long drawdown phases with very severe drawdowns in percentage can be a red flag, because in your real-time trading, when you're in a drawdown, fighting yourself out of the drawdown can be very difficult, and it's much more difficult than in a backtest, because in a backtest you fast forward, you get a few trades and you're back to break even, whereas in real trading, obviously this can take days, weeks, or as a swing trader maybe even months, and that's something to also then consider. The smoothness of the equity curve in general is something to always analyze as well. How smooth is the development of your equity graph? And yeah, because of the drawdowns and the very moderate drawdowns, it looks fairly good. There is one period here where you have a prolonged period of break even. So here around maybe trade 82, 85 until trade 120. So around 30 trades, there is a very long sideways period. So as a swing trader, this can take weeks or months, maybe even. It's important to understand that it doesn't have to be a red flag, because eventually the market, or eventually the performance picked up again and the trader was able to make new all-time highs on the performance. But this is something just to be aware of, just like the drawdown. It's just important to be aware of it, so that when you're in your live trading, you know that this is completely normal. And that's one of the big benefits and advantages of having such a backtest with detailed data, that you can just look at your backtest and see, okay, this happened actually in my backtest, so I'm experiencing something very similar at the moment. It's totally normal, and that is then going to put your mind at ease. This is also going to help you to understand the consistency across different market conditions. So here we have a backtest spanning years, obviously, and this shows you that the strategy is not fitted to just one market phase. So if you do a backtest and you maybe only backtest 6 months or 3 months as a day trader, you might have a very specific market condition that you're backtesting. And that might be the period or the market condition that favors your strategy, but you don't really know how your strategy will perform outside of such market conditions, and it could easily fall apart and give you very different results. So it's really important to also understand the consistency across market conditions. So it can be very helpful to test a longer period in your backtest and see that you test your strategy through different market periods. So now let's take a look at the scalability of a trading system. First of all, what we want to see, the instruments. So here we can see there were some futures, indices, currencies, commodities, a Forex pair, 2 Forex pairs. So it looks like this was backtest on a few select markets. There's not really a single very bad outlier here. Crude oil, maybe something to consider, but this is more or less break even. If we factor in transaction costs, this might look a little bit worse. So keeping an eye on crude oil and seeing how this develops over time, maybe until you have 30, 40 trades. If it still doesn't perform, you need to look into this deeper to see if this is really something that maybe you should drop, or you should see if crude oil requires a different approach. That would be then topic of another video where we dive deep into the specifics of the trading system. Swiss franc, 5 trades, 7 trades on corn, 12 trades on silver, but those are performing positively. Again, remember, transaction fees are not factored in here. However, what this tells us that we probably could expand this strategy to other markets, and that's where the scalability comes in. As in the beginning, we understood that 65% over 10 years without transaction fees is probably something that is borderline acceptable. You might be able to get more return out of a passive investment rather than having the stress of trading this live. However, if you add more markets, and as a swing trader, you typically very easily can do that because you have the time and you don't have the stress and the pressure of monitoring a lot of markets in real time. This could be probably done very easily. And then if you add double or triple the amount, your performance will also probably look much, much better. So that's definitely something that is positive here, even though the performance is not probably something that is great at the moment or super exciting, I would say. The scalability and the potential here, I think, is there, that it still might be worth considering taking this live. So that is very good. Setup-wise, we only have one setup. It's a supply and demand. Okay, fair enough. So you don't have any underperformers or outliers. That's all right. The other thing we can check is risk distribution. So we can see how much risk is the trader taking. 1% seems to be like the typical position size. Wherever you see the largest bar or the cluster of bars, that's typically where you have your largest or your average position size. For a day trade or for a swing trader, you often, when you listen to the podcast and read the books of the professional and the best swing traders, often swing traders say that they have larger positions than the regular 1%, just because you don't have the day-to-day fluctuations of a day trader. Especially if you can prove in a live environment that you can sustain the results that your backtest shows you, you can consider maybe increasing your position size slowly, of course. So you want to monitor yourself and how you feel about the added risk. But this is another thing where you could improve the scalability and really push the performance of this system. Again, of course, this needs to be done with care, and increasing your risk should be done slowly, and you should monitor yourself if you can handle the pressure. But this is something that definitely would be something to consider for this trader if or when the trader decides to take this live. But scalability-wise, I think there are a lot of good points and a good of options here that would maybe help improve the performance further. Of course, in a backtest, you don't have problems with all of the discipline issues that typically come up and that we typically see. So waiting for the perfect entry, holding trades optimally, especially as a swing trader where you have to hold your trades for weeks, or as we can see here, for months at a time. Those are excluded in your backtest, so that could add a lot of other risk factors for this strategy. But overall, this looks promising, and we hope that this helps the trader, but also other traders when they're evaluating their backtesting analysis and data in their Edgewonk trading journal.